Germany's economy is famous for its manufacturing might, cars, machinery, and engineering excellence. But behind the scenes, the services sector is just as vital, powering everything from banking and healthcare to logistics and tech. This sector employs most of the workforce and drives a huge share of Germany's GDP. The health of services is a direct reflection of the nation's economic well-being. When services thrive, confidence and investment follow. When they falter, warning lights flash for the whole economy. Recent data from September 2025 shows a glimmer of growth in services, signaling resilience. Yet, beneath the surface, challenges remain, making this a story of cautious optimism. Understanding these shifts is key to predicting where Germany's economy is headed next. To truly understand the health of an economy, economists and analysts turn to a powerful tool known as the Purchasing Managers' Index, or PMI. This index is one of the most closely watched indicators in the world of finance and economics, providing a real-time snapshot of how businesses are performing and what might lie ahead for the broader economy. The PMI is calculated through a monthly survey that's sent out to hundreds of purchasing managers across a wide range of industries. These managers are on the front lines of business, making decisions about buying materials, hiring staff, and managing production. The survey asks them a simple but powerful set of questions. Are business conditions better, the same, or worse than the previous month? Their responses offer a unique, ground-level view of economic momentum. All of these answers are carefully compiled and distilled into a single, easy-to-understand number, the PMI. This number is designed to cut through the noise and give a clear signal about the direction in which the economy is moving. The PMI is structured around a baseline of 50. If the index reads above 50, it means that most businesses are reporting growth and expansion. If it falls below 50, it signals that contraction is taking place, and the economy may be slowing down. The further the PMI moves away from 50, the stronger the trend, whether it's a surge in activity or a sharp downturn. This makes the PMI a sensitive gauge, able to pick up on subtle shifts before they become obvious in other data. What sets the PMI apart is its speed and forward-looking nature. Because it's based on current business conditions, it often predicts changes in GDP, employment, and industrial output before official government statistics are released. This gives economists, investors, and policymakers a crucial head start in understanding where the economy is headed. For business leaders and policymakers, the PMI acts as an essential early warning system. It helps them spot turning points in the economy, allowing for quicker and more informed decisions about investments, hiring, and policy changes. When the PMI rises, it's often a sign that economic growth could soon accelerate, with businesses ramping up production and hiring to meet rising demand. A falling PMI, on the other hand, can be an early signal of trouble ahead. Investors, governments, and central banks all pay close attention to the PMI. They use it to make critical decisions about interest rates, fiscal policy, and market strategies, knowing that this index can provide valuable clues about the future. In short, the PMI is like the economy's pulse, quick, reliable, and vital for navigating uncertainty. It helps everyone from CEOs to policymakers keep their finger on the economic heartbeat. Now, let's take a closer look at what the latest PMI numbers reveal about Germany's economic outlook. September 2025 brought good news. Germany's services PMI rebounded to 51.5, its first expansion in months. This jump from August's 49.3 marks the fastest growth in 8 months. Service companies, from IT to travel, reported more business activity and improved conditions. The final figure was slightly lower than the initial flash estimate, but the positive trend held. This expansion suggests domestic demand is stabilizing, offering a psychological and economic boost. Even modest growth in services helps offset weaknesses elsewhere. For Germany, this is a much-needed sign of momentum. Still, the recovery is fragile, and deeper challenges remain. The services sector's resilience is now central to Germany's economic outlook. To see the full picture, we turn to the composite PMI, which blends services and manufacturing data. In September, Germany's composite PMI hit 52.0, a 16-month high. This signals solid private sector growth, driven mainly by services. The strong services performance offset ongoing manufacturing weakness. It's like a star player carrying the team, lifting the whole economy. This resilience shows Germany's adaptability, When one sector stumbles, another can step up. The positive composite reading is a foundation for cautious optimism. Diversification is Germany's strength, helping it weather industrial slowdowns. For now, the recovery is on track, but the path remains uneven. Policymakers and businesses are watching closely for signs of lasting momentum. Despite a recent uptick in overall activity, the September PMI report has highlighted a deeply concerning trend. New business in the services sector is still on the decline. While some areas of the economy are showing signs of life, the reality beneath the surface is far less optimistic. The data reveals that, even as companies appear busy, they are not attracting enough fresh orders to sustain long-term growth. This signals a potential warning for the months ahead. Many companies are currently occupied, but much of their workload comes from fulfilling backlogged orders rather than securing new contracts. This means that while offices may seem bustling, the pipeline of future work is running dry. The lack of new business is becoming increasingly apparent, and it's starting to weigh on overall confidence within the sector. For the second consecutive month, the volume of incoming business has shrunk, pointing to a persistent weakness in underlying demand. This isn't just a temporary dip, it's a sign that customers are holding back, perhaps due to economic uncertainty or shifting priorities. Without a steady influx of new orders, the outlook for future activity becomes increasingly uncertain. Companies may soon find themselves with idle staff and underutilized resources, unable to maintain their current pace. As backlogs dwindle, the risk of layoffs or reduced hours grows. If demand doesn't recover, businesses could be forced to make tough decisions about staffing and investment. This growing disconnect between current activity and future orders exposes just how fragile the recovery really is. The apparent strength in today's numbers may be masking deeper vulnerabilities that could surface in the coming months. The modest growth seen in September could easily fade if new business fails to rebound. Without a turnaround, the sector's momentum may be short-lived. This is a clear warning sign. The services sector urgently needs a revival in demand to keep moving forward. Without fresh orders, even the busiest companies will struggle to maintain their operations. The future of the sector depends on reigniting customer confidence and encouraging people to spend again. Only then can businesses hope to see a sustained recovery. Without renewed demand, the fragile recovery could quickly stall, leaving businesses and workers facing an uncertain future. While services grew, Germany's manufacturing sector slipped back into decline in September. After 3 months of rising orders, new manufacturing business fell sharply. This setback highlights the economy's imbalance. Services are expanding, but factories are struggling. Manufacturing slump threatens jobs and supply chains across the country. The global demand for German goods remains fragile, and industrial recovery is far from certain. The composite PMI's strength masks these industrial weaknesses. For a true, broad-based recovery, Germany needs its manufacturing core to rebound. The most troubling news is that, despite the recent growth in the services sector, employment within this area has actually declined for the second month in a row. This is a worrying sign, especially since the services sector is often seen as a key driver of job creation and economic stability. Many had hoped that as business activity picked up, more jobs would follow, but that hasn't been the case. Normally, when companies see more business, they respond by hiring new staff to keep up with demand. However, in this situation, we're seeing the opposite. Firms are actually cutting jobs, even as their order books grow. This unusual pattern is raising concerns among economists and business leaders alike. The pace of job losses has accelerated, reaching its fastest rate in over 5 years. This sharp increase in layoffs is a clear reflection of the deep uncertainty that many businesses are feeling about the future. Employees are left anxious, unsure if their jobs will be next. Managers are being forced to make tough decisions. With shrinking backlogs of work and a lack of strong new orders coming in, many have no choice but to reduce their workforce. These decisions are never easy, but they're becoming more common as companies try to stay afloat. This wave of job cuts doesn't just affect those who lose their positions, it also creates a negative cycle throughout the economy. When people lose their jobs, they spend less, which hurts businesses and can lead to even more layoffs. Consumer confidence drops, and demand for goods and services weakens further. The disconnect between business growth and falling employment is a major red flag. It suggests that the recovery we're seeing in some sectors isn't translating into real benefits for workers. This could signal deeper problems within the economy that need to be addressed. Right now, the recovery remains fragile. Many workers are not feeling the positive effects, and uncertainty is high. If businesses continue to hold back on hiring, the gains we've seen could quickly disappear. If this troubling trend of job losses continues, it could stall Germany's broader economic rebound. The country's ability to recover from recent challenges depends heavily on a strong and stable labor market. In the coming months, all eyes will be on the labor market. It will serve as a crucial indicator of whether the recovery is truly taking hold, or if more challenges lie ahead for workers and businesses alike. The job losses in services have sparked debate about technology's role in the workplace. As AI and automation advance, companies are rethinking how many employees they need. In services, AI can handle tasks from customer service to data analysis, making it easier to cut jobs when demand drops. This shift isn't about robots replacing everyone overnight. It's about doing more with less. When business slows, firms use technology to stay efficient, often at the expense of jobs. The big question, will new tech-driven jobs emerge fast enough to replace those lost? Germany's current employment slump is an early test of this new reality. The future of work will depend on how quickly workers, companies, and policymakers adapt. Amid mixed signals, one bright spot stands out. Business optimism surged in September. Service providers are more confident about the year ahead than at any time since May 2024. Many believe that inflation and high interest rates are easing, setting the stage for a demand rebound. This optimism could become a self-fulfilling prophecy, spurring investment and future hiring. The return to growth in services is real, but underlying weaknesses can't be ignored. Still, the spirit of enterprise remains strong. If optimism translates into real demand and jobs, Germany's recovery could gain lasting strength. The coming months will reveal whether hope can turn into sustainable growth.